Good afternoon. We're the University of Idaho. I'm Mackenzie Kennedy.
My name is Ryan Zimmerman.
Alex Howard.
All right, and today we're here to talk to you about Banner Corporation and our analyst opinion on it. Just a quick company overview. Banner Corporation is a holding company for Banner Bank, and they serve the Pacific Northwest region. So they have branches in Washington, Oregon, Idaho, and California. As you can see here, they're most densely populated in Washington with 95 branches. Our recommendation is that you issue a buy on Banner with a target price point of $59.69 and a 5.48% upside. Why buy Banner? Banner has shown focused geographical expansion through strategic mergers and acquisitions while implementing new technology. We're going to take a quick look at financial ratios. We're going to focus on operating performance, so we can see the return on assets is 1.33, return on equity is 10.71, and we can see that there's an upward swing in the return on assets, although it is slight. Looking at Porter's 5 forces, we're going to focus on the threats of new entrants, current rivalry, and then also substitutions. Because Banner has a unique size and they're not the smallest of banks, they're also not the largest of banks, we see that really their rivalry is going to be the big banks impeding in on their market share and offering different things that Banner may not be able to afford. Threats of new entrants is low because you have those smaller banks who don't have the capital to maybe acquire and make strong growth quickly. And so we're going to see that really it's going to be those large banks that are going to affect Banner. All right, next we're going to go ahead and talk about investment risks. So for Banner, because they're geographically concentrated, we can see that national and local economic downturn is going to be more severe for them in that Pacific Northwest region. We also see credit risk and interest rate risk. Those are typical industry risks. Acquisition risk for Banner, because they are mainly growing through acquisitions and mergers. If they have back acquisitions, that would highly affect them. But Banner's track record has been good with those. And then technology, they're introducing some new technology. So we look at privacy risks and security.
For a competitive overview, what we decided to do is take a look at similar banks in size. So we took a look at Community Bank, ticker CBU, as a direct comparison to Banner Bank. And we also decided to take a look at a smaller bank, First US Bank, and a larger bank, US Bank, to see if we can tell a story with them. So in terms of acquisitions, we compared Banner with Community Bank. As you can see, Banner Bank has more acquisitions than Community Bank and far outpaces in terms of the average dollar amount per acquisition. The reason why US Bank and the smaller bank is not on this acquisition chart is because US Bank is a little bit out of Banner's league, and the smaller banks don't have enough capital to acquire companies as fast as these do.
The first reason we want to issue a buy in Banner is because of their strategic mergers and acquisitions. Since going public in 1995, there have been 12 mergers and acquisitions, and most have been very successful, resulting in increases in assets under management and number of branches for Banner, as well as increases in stewardship for the banks being acquired as they recognize the good reputation that Banner has. The acquisitions had little effect on Banner's stock price. Likely the larger price moves happened in the stock prices of the banks that were being acquired. Here we can take a snapshot look at the most recent acquisition, the Alta Pacific Bancorp acquisition. This happened last year at the end of 2019. Alta Pacific shareholders were awarded 0.27 shares of Banner stock for every share of Alta Pacific stock that they had. And the goal of this acquisition was to expand into the California market. The deal closed Q4 2019, and system integration is happening now in Q1 2020.
So one of the main reasons why we like Banner Bank is its focused geographic density. We like that the states that Banner is in far outpace the average growth rate for the United States, at least the forecasted growth until 2030. And another reason why we like it is these 4 states are projected to take 24% of the US GDP growth over that period of time.
And the third reason we want to issue a buy for Banner is because they're lead in technological advances. They're working on implementing a smart ATM system, which could replace a lot of the work that a bank teller could do. And this will be great in reducing overhead costs because they could locate many of their tellers in perhaps a call center, and which would lower real estate costs, which is great because of the expensive markets that they're focused on expanding into. We consider this to be a high risk, high reward investment because there are a lot larger players in the tech industry and the technology sector moves very quickly. So we decided to use a dividend growth rate for our valuation model instead of a discounted cash flow model, because when working with a bank, it's difficult to do a discounted cash flow model because it's hard to distinguish uses of cash, whether it's for financing, investing, or operating activities. So the first thing we had to do for Banner was to establish a regular dividend growth rate. So we took the average growth rate from 2014 to 2018 to give us a 20% growth rate. And then that average growth rate of 20% to the growth rate of 12% in 2019 was an 8% drop. And another 8% drop, we would settle with a 4% growth rate. So we feel that Banner has been in an aggressive dividend growth stage. Currently, they're in a declining dividend growth stage, and they'll settle at a sustainable 4% growth rate. And we wanted to compare this dividend with another similarly sized community bank, US Bankshares Incorporated, they're a similarly sized regional bank that is out of their aggressive dividend growth phase. So the yield on US Bankshares Incorporated is 3.74%. So we set Banner's target yield to 3.5%, which at the current stock price led to an annual dividend of $1.90. And this $1.90 annual dividend aligns perfectly with one more year of an 8% decline in dividend growth rates. For the dividend discount model itself, it returned $50.46, but dividend discount models do not include any special dividends, which Banner happens to pay on a really regular basis. On the right, we can see that over the past 3 years, every year a special dividend has been included. So our target price of $59.69 comes from our dividend discount model with one 30-cent special dividend included.
For competitive overview, what we took a look at is net income for Banner and its competitors. And as you can see, Banner Bank far exceeds its competitors on a compound annual growth rate. And what we would expect, if you look at a relative basis, is higher PEs and price to books. But as you can see, Banner trades at a discount compared to its peers. And we believe that's due to Banner's actions during the financial crisis. We believe that the governance that was taken at that time wasn't appropriate, and they had to dilute a large amount of shares, which Banner is still being punished for. But we believe with the new governance with Banner, that discount will slowly fade away as we have faith in their leadership.
For our sensitivity analysis to make sure our target price was within a reasonable range, we ran a Monte Carlo simulation, which returned this normal distribution. And to do this, we calculated the average daily return for Banner over the past 8 years, and then we ran that average daily return out 250 days from the 2019 close, 250 days for 250 trading days in a year. And we then created a data table with 1,000 possibilities for that 250th day to create this simulation range for 1 year forecast on the stock price. This distribution had a mean of 56.5 and ranged from just below $54 to just about $60. We also ran a blue sky and gray sky analysis to see how our target price would react to different economic events. The most influential economic event for Banner is their acquisitions, which could positive acquisition news could lead to a 10% upside in our target price to just above $65, and poor acquisition news in 2020 could lead to a 10% downside in our target price down to just under $54.
All right, so in conclusion, we expect that focused geographical expansion, the strategic mergers and acquisition, and the new technology that Banner is getting into to boost Banner, and that's why we recommend a buy with a 5.48% upside and target price $59.69. Thank you. We're the University of Idaho. Now we'll take questions.
So one of the risks I think for like Banner Bank is the Fed lowering rates. And right now the Fed kind of has 1 to 2 rates kind of forecasted to lower for the rest of the year. How do you see that affecting stock price or maybe profitability for Banner?
Yeah, so obviously the margins, right? Bringing those margins shorter, that is going to affect Banner, and we expect it's going to bring their margins smaller, and so Banner is going to have to be able to keep well, okay, let me think here. So for that, it's going to affect Banner. It is going to affect, and they're not going to be able to make as much money on that. And so what we're looking at is we expect Banner to be able to move through that and sustain while, even though they're at those lower rates and their margins aren't as high, we expect them to then still be able to sustain through that.
And also, I'll add on that just real quick here. So Banner's really focused on these geographic areas with really high tech sectors and huge potential GDP growth. And as we all know, as rates drop, equities go higher. So this will lead to a wealthier community to invest or store their assets with Banner Bank, which an increase in deposits or an increase in loans could also offset those lower interest rates.
Okay. And then for the non-performing assets, it looked like in fourth quarter of 2019 that those actually doubled. Do you know where that write-off might have came from, and is that going to be portrayed to maybe in the future? You see that as a trend?
Okay, so I'm not positive there. So what we saw similar like in 2014 too, and saw the dip down again. But we have seen like 2016 we saw a jump, and then it slowly recovers for 2017 and then back up to 2018. I would say we expect, I mean, you're looking at everything was performing extremely well, but I would expect a slight drop, but then to continue on at an upward trend. So a slight drop down and then continue on.
Thanks.
You guys mentioned some of the acquisitions they've made, and you mentioned Alta Pacific. Do you know how much they paid? Well, I guess you have it listed, or that's assets. I guess how much did they pay for Alta Pacific? You know?
No, I don't know. I just know that the target asset under management was just over $400 million.
Okay, gotcha. Okay, good. And then you guys, slide 18, looking at the competitive overview, you mentioned that net income increased at a substantially higher clip than competitors. Is that just aggregate net income, or is that net income per share?
That's just aggregate net income over